talking about triangles. Now, chart patterns and triangles are part of chart patterns, are well documented in technical analysis literature and are based on the psychological phenomena that occur between buyers and sellers of financial instruments in liquid markets. Pattern formations do not form a trading system, but rather provide an indication of future trends of an asset as the price breaks key psychological barriers in the form of support and resistance. Now, the hardest thing for traders to understand or accept is that the market is all about psychology. Everybody thinks that they can do this black box stuff and put all these formulas together and all these trading indicators, and it's going to tell them what exactly to do. But the fact is, the market is made up of millions of human beings, and these human beings' minds change, moods change, attitudes change, and this is why price moves. And there's no way to predict what the psychological makeup will be of the markets at any given time. So ultimately, price action is what tells you what is happening. Now, what we try to do is find ways that we can understand what human nature is doing in the markets. And we do this by looking how human beings reacted in a certain way in the past and many times in the past so that we can see that same pattern evolving in the current price. We know, or we can fairly well predict, that this is how the psychological makeup of the market is going to react. It's like a doctor trying to figure out what's wrong with you. Okay, you don't feel well, you can give him some symptoms. But what's he do? He can do tests and symptoms. He's got to evaluate it by all the people he's seen before that have had these same symptoms and these same tests, and compare in his mind what he expects to be wrong with you, because there is no fine definition that he can say, yeah, he can tell you have cancer. Just like I can tell you the market went down. But there's no way anybody can predict that you're going to get it. Now, statistically, they can say, but this is the same thing. It's all random. Now, I'm sure you've all heard about chart patterns for online trading and the relationship to technical analysis. You probably know about double tops and triple tops and head and shoulders and rectangles, but the chart patterns themselves have a very small range of the ones that are really recognized. Okay. Now, we can call these market structure. I'm waiting for them to pop up on your screen there. Okay, come on. For some reason, the internet seems to be extremely slow this evening. But there we go. Now, if you look on this price chart, we can see, starting from the left and moving to the right, we have a double bottom, we have a bull flag, we have a bull pennant, we have an ascending wedge, we have a descending wedge, triple top, bear flag, bull pennant. But there's only a handful of these chart patterns that we've interpreted and we can rely on. Now, tonight we're talking about triangles. I don't use double bottoms. I might consider triple bottom, but they're not part of triangles. Okay, a bull pennant, a bear pennant. Let's remember, there's something on each side. Okay, an ascending wedge and a descending wedge. Okay, I classify them all as triangles. An expanding wedge. Okay, they're all triangles. Okay, there's different definitions of triangles. We have ascending triangles, descending triangles, symmetrical triangles, but I also consider an ascending wedge, because the only difference in an ascending wedge from a basic triangle is that the two lines forming the wedge are at different angles, different degree angles, but they still do exactly what a triangle does. A bull pennant and a bear pennant, same thing. So I call them all triangles, and you'll see in a minute why. Because all of their interpretations and all the outcomes are always the same. So here we can see the formation, and it's already happened, of a triangle. Okay, and we can see the breakout of the triangle here, and where we had predicted the target area. Okay, we see our support and resistance lines. Okay. Triangle, easy. Whether it's an ascending, a descending, and asymmetrical, doesn't make a difference. Now here we have a textbook descending triangle. Same, what'll happen is we're going to apply the same reasoning and the same strategies to this triangle pattern. Now, this triangle happened to tell us a lot because here we have a beautiful triangle and we have a breakout. We had a breakout downward, and the key to our strategy for using triangles is you have the breakout candle here. You wait for the second candle, that's a confirmation candle, and then you enter your trade on the third candle. It won't get you in the trade earlier than somebody else who just jumped at a breakout, and it won't get you, you might lose some pips. It might invalidate a lot of the trades you might have made. But if you wait for the third candle, your percentage of success rises exponentially. So let's go back and talk about these different triangle patterns. And then we're going to talk about how you would apply your stop loss, how you'd apply your target, your take profit points, and how you would apply your decision making. So let's go back to the PowerPoint. So in order to have a complete understanding of chart pattern trading, we should also begin with a good understanding of most of the common on-chart formations, which we just looked at. What I'm referring to are triangle trading patterns. So in this webinar, we will discuss the basic triangle formations and some ways to properly identify and trade these patterns. The triangle pattern is a specific figure formed on the price chart, typically identified when the tops and the bottoms of price action are moving towards each other, like the sides of a triangle. When the upper and the lower levels of the triangle interact, traders expect an eventual breakout from the triangle. Now, if you notice, I don't say whether it's going to break out upward. I don't say it's going to break out downward. I don't say it's a continuation triangle. I don't say it's a reversal triangle because I don't apply any of those to triangles. I wait for a breakout to tell me what is happening. So as such, many breakout traders use triangle formations to identify breakout entry points. So there are different kinds of triangles that can be seen on a price chart. Before you jump into triangle trading, you should understand the differences between these formations. So what we're looking at on the right side is called a symmetrical triangle. It's symmetrical. The upper and the lower support and resistance lines are on the same basic angle, and they're converging towards the center. Okay. When we draw these lines, they converge. Doesn't mean that price is going to converge, but when we connect the tops of price movements together and we connect the bottoms of price movements together, we would expect this, wherever we draw them, we would expect price to continue moving in here or at some point break out of this triangle. It's important to realize where the second line begins, because one line will, maybe the support line or the started way back where. Okay, we need to be aware of where the second line, like in this time, where we were able to connect the lines to make our upper line, because this is the difference that we're going to, this is where the triangle formation actually began. Okay, and this difference is something we have to be aware of. So what we're looking for is, this is a downtrend. We're looking at highs getting lower and lows getting higher, and they're being forced into this apex of the triangle. Let me just clean up this chart a little bit here. Okay. Now the symmetrical triangle is a situation on a chart where the tops of the price action are lower and the bottoms are higher. Also, the two sides of the triangle are inclined at basically the same angle. This creates the symmetrical character of the triangle. Now, the reason we have to see where the second angle begins is because we then measure the width of the triangle, and we can take this triangle measurement and apply it to the breakout. So when we get a breakout, we would expect it to go up this distance upward if it breaks out upward, if it breaks out downward, this distance downward. So this would allow us to set our target price or where we would place our limit order. But we'll get to that a bit more in a minute. Okay. Typically, with a symmetrical triangle pattern, the expected directional breakout, and this line you have to just take, the expected directional breakout is unknown. The reason for this is that the bullish and the bearish move have equal strengths as seen through the price action. Now, when a breakout eventually occurs, it is likely to provoke a price move equal to the size of the pattern. Therefore, you should carefully identify the potential breakout in the upper and the lower levels of the symmetrical triangle in order to take the right position in the market. As you can see from this example, the potential target is based on the size of the triangle formation. With this type of measured move analysis, you will know what to expect from the triangle breakout, whether it breaks upward or downward. Now, besides symmetrical triangles, we have ascending and descending triangles. Now, if you've noticed, I have not said anything about bearish or bullish characteristics or bias because I don't believe in them. And if you start believing that when you see an ascending triangle, the breakout should be bearish or bullish, you tend to force yourself into a decision. So these types of triangles have one flat side where price is moving across flat and one angle side or one sloping side. This is moving towards the flat horizontal side. The ascending and descending triangle patterns are mirror images of each other. They are identified as ascending or descending depending on which side the flat side is on. So if we have the flat side here and an angle, we have an ascending triangle. If we have the flat side here and the angle, we have a descending triangle. Now, this triangle pattern has an upper flat side and a lower ascending side. In this manner, the tops of this triangle are on the same level and the bottoms are increasing. This type of triangle typically has a bullish character. Okay. This is what people say. I do not listen to this. Okay. When you spot this triangle on the chart, you should be prepared to catch a bullish price move equal to the size of the triangle. Again, that makes you particularly biased to looking for a breakout upward. I say don't make that decision. I'm going to show you later in this class. We actually tested 525 triangle patterns to see if they ever really did have a strong bullish or bearish. So on this chart pattern, the black lines above price indicate within the triangle form are the price action. The blue lines refer to the sides of the triangles, and the red lines correspond to the size of the triangle and its potential target, which is typically one-to-one measured move. When the ascending triangle is formed during a bullish trend, we can expect a continuation of the trend. That is so misconceiving. Okay, until you see a breakout, you can't make any decision because, like I said, it's all market psychology. Okay, you might see this beautiful, and then this triangle breaks out downward. So don't get yourself stuck into this characteristics. As noted earlier, the ascending and descending triangles are mirror images of each other. When the descending triangle is created during a bearish price tendency, we expect the trend to continue. I don't care. We're not looking at trends. We're not looking at long-term investments. We're looking at short-term trading, and we need to see which way it breaks out. It's very important to mention that the ascending and descending triangles sometimes break through the incline level, causing false signals and trapping some traders along the way. The same holds true for horizontal price zones. You should always try to wait for the close of the candle to confirm the breakout. This will help reduce the many false signals. We're going to really reduce those false signals because we're not going to wait for just one candle. Now, pennants are slightly different. They still form triangles. And you'll hear people talk about pennants and flags all the time. Pennants on a chart have a similar shape of that of a symmetrical triangle. They typically appear during trends and have a trend continuation character. They're just triangles that are formed during a strong uptrend and a downtrend. Now, the one thing you should be aware of is the more defined the trend is, the more likely the triangle, and the more well defined the triangle is, the more reliable its signal will be. So again, we have symmetrical triangles. We have wedges, which are simply just triangles where instead of having a support and a resistance line with a horizontal and sloping, or two same sloping angles, we have two lines above and below that are sloping at slightly different angles. Again, we have symmetrical triangle. We have a bearish pennant, which is simply a triangle. Now, how do we start using this triangle? We've already talked about measuring the width of the triangle. This is what we use to set our target point. We would look to put our stop loss about 10 pips below the swing low right before the breakout, or the swing high, depending on which way it breaks, of the breakout. We would enter our buy based on the breakout confirmation candle, which is not the candle that breaks out, but the candle that is formed after that. And then we would wait for the formation of the third candle to enter, in this case, the buy. Okay. So we would set our entry price, but we would still wait for that confirmation candle. If we don't, we will tend to get sucked into false breakouts. So how can we trade these triangles successfully? Okay. Again, this is the same one we were looking at on the entire chart, and we can see as price continued how well it moved. Now, again, we have the breakout candle here. We had the confirmation here. We had the third candle. We entered at this point for our buy with our stop loss here, and our target point would have been about here. We need that target point to calculate our own risk management or risk reward ratios to see if we can actually afford to make this trade. So once a triangle has been identified in the chart, traders will wait for the breakout either above the resistance trend line or below the support. After the breakout is confirmed with either a closed candle above resistance or below support, a stop is placed approximately 10 pips below the last swing low of the triangle. A limit equal to the height of the triangle is then placed. So once again, step by step, we have our formation of our candle, of our triangle. We measure the width of the triangle, okay, and we wait for the break. We get the breakout here. This is the close of the breakout candle. We can then lay this width here to set our limit order, or this is our profit. Okay. We would put our stop loss. Here's our swing low before the breakout. We would put our stop loss about 10 pips below it, and we would enter our entry point. See, here's our breakout candle. Here's our confirmation candle and the close of the confirmation candle. And then we wait for this third candle and enter at that point. Not the close of that candle. We wait for it to start forming. And that's when we would enter the market. So let's go over to some live charts and let's see if we can spot something. Okay. Now on this beautiful descending triangle, we got our breakout candle here, our confirmation candle, and our third candle, which gave us our entry point. We would have entered here, we would have sold down, we would have put our stop loss here, okay, and we would have had a very profitable trade. If we cannot, because price bounces back in there, the highs back in there, the second candle did not confirm and stay outside, then we just don't make the trade. There's always a billion other trades to make. So here we have, and this is a live chart, we have a beautiful candle triangle formation. Okay, it's still moving into the apex of this triangle. So we can move our lines down farther. Okay, and we're still waiting for something to happen. Okay, we could set our, let's see if I can pull this down so we can see it. So this would give us the width of our triangle right there. But we have no inclination of where it was going to go. Okay, so we don't have a breakout at this point, and we don't know what's happening. Now, this is actually defined as a falling wedge. Why? Looks just like a triangle. But if you notice, the two sloping sides are not the same degree, same angle. And that's the only difference. But we still want to apply everything the same. So we could estimate what we might think is a target point for the price, but we have no indication of anything at this point. So we would wait to get that breakout. Let me get volume off. Let me shut the volume off so it's not misconceiving you here. Because volume is a very important part of this. Because volume is one of your final confirmations. So here we would just sit back and wait. That's all we're going to do is wait for this triangle to approach the upper or the lower and give us a breakout and then a confirmation. Here, we've already discussed it. We got the breakout here. Second candle, entry point. This would have been the target area here. We would have set our stop loss down here. And we would have had a nice trade, not a hugely profitable trade, but we would have still gotten from 10,475 to 1106. Gotten the $1,100 range for the Bitcoin. So we would have made $500 per Bitcoin. That's not such a bad investment. So we do the same exact thing for an ascending triangle, except we mirror it. We put our buy. Okay, now watch. We would have, here is our horizontal support line, resistance line. Here is our angular support line. Okay, we would place our buy. We had the breakout right here. We're still waiting for confirmation. So we have the close of the breakout candle, but we cannot make a trade at this point. We would put our stop loss at the below the low, the swing low of the in that previous trading area. Okay, but we can't do anything yet. We're not making a trade. We're not ready to make a trade. We're sitting back and waiting. Now, what happens is we get the confirmation candle and we would enter the trade. Stop loss set down here, and the price still moved all the way up here to F, and we would have probably closed around G. Okay, we would have entered the trade at 141 and exited at 142. Okay, still a nice profitable currency trade. Again, you can see here, we have an ascending triangle. We have the breakout right here. We put our width of the triangle onto our price chart. This is where we'd set our limit order based on the width of the triangle. We would put our stop loss below the swing low, 10 points below. Okay. We would have not traded on this candle. That's our breakout candle. This is our confirmation. And see, we don't care on the confirmation candle whether it's bullish or bearish. We just don't want it returning into the candle. And that's why we wait to the third, because we have to wait till this candle completely closes. And then we would enter and trade on that third candle. So we would have entered somewhere around here, and we would have taken and moved all the way to our limit order with no problem whatsoever. Same thing for in the descending triangle. All we're doing is flipping everything over. But again, we can't enter this trade because we don't have a confirmation yet. We set our entry point, but we don't have a confirmation, so we're not ready to make a trade. So we're still sitting back waiting for the confirmation candle. Now we get the confirmation candle. Here's our breakout candle, our confirmation candle, and we would enter on this third candle. And here our stop loss is placed at 10 pips below the swing high. And our limit would have been to here, but we had a nice solid trade. Now remember, I told you there's a little secret weapon here, and we call it volume. Volume has to be accelerating in order to confirm the breakout is a good breakout. So we want to ask, number one, how reliable are triangles? Well, we tested a whole bunch of triangles going back over historic values of triangles. And so on a 4-hour chart, we tested 165 symmetrical triangles to see if they had a bullish or a bearish bias that actually held out. We tried it in 5 different currency pairs. We can see in the 4-hour time frame, yes, the USD, the Canadian dollar, the CAD, showed a 61.5% correct bearish prediction. For bullish, it showed a 57.1. That's not so bad. But the Japanese yen, it was terrible. It was 33% and 40. The pound was 52.57. The dollar was 61.65. We got an average of 54% of the time on a bearish symmetrical triangle that we were right, and in a bullish 54. Well, to me, 54 and 57, I'm not a casino. I'm not running on a 2% rate. I need bigger profits and I need more reliability. So what I want to do is say, okay, what can I do next to make this a reliable decision? Okay. Well, I find if I throw out the bearish and bullish and decide how I'm going to react after the breakout, I get more successful. So if I were to take the triangles down to 1-hour patterns, I only end up with a 51.7% bullish bearish correction and a 52% bullish correct prediction. Okay, so in this test, there was a total of 525 patterns on all charts over a period investigated. The pattern was correct in predicting a continuation of 52% of the cases. So that means if it was a bearish trend, if only 52% did a breakout in a bearish direction and wasn't correct. And again, the bullish pattern had a slightly better odd, but that's not enough odds for me. So even though the numbers are quite small, this does give some objective data on the reliability of triangles across Forex pairs. But the question is, how do we move the odds in our favor? When the pattern ends, the volatility dips to a minimum and support and resistance lines will be very close. The market will then usually start to show some preferred direction. So that's it. If we wait for the market to show us the preferred direction and the breakout, there's no guarantee of this, however. As always, it's best to prepare for false breakouts and retests of the support and resistance lines. But we found that by waiting for the third candle, our success rate went up to 70% accuracy. Well, yes, there were a lot of possible trades I could have made that I didn't make that could have been highly successful. But my rule of thumb in trading is I only want the highest potential trades possible. So the easiest way to trade the chart pattern is to treat it as a continuation breakout. To Here we just wait for a clear break above resistance in a bullish trend, or wait for a clear breakout below and as a bearish trend. Doesn't give us much. So while there are instances when symmetrical triangles mark important trend reversals, they more often mark a continuation of the current trend. Regardless of the nature of the pattern, continuation or reversal, the direction of the next major move can only be determined after a valid breakout. So what we want to do to increase our successes, number one, we want to look at the trend. In order to qualify as a continuation pattern, an established trend should exist. The symmetrical triangle marks a consolidation period before continuing after the breakout. The ultimate key is looking at volume. As a triangle extends and the trading range contracts, volume should start to diminish. This refers to as the quiet before the storm, or the tightening consolidation before the breakout. When we get the breakout, we should then see a jump in volume. Okay. And the future direction of the breakout can only be determined after the break has occurred. Sounds obvious enough, but attempting to guess the direction of the breakout can be dangerous, even though a continuation pattern is supposed to break out in the direction of the long-term trend. This is not always the case. So we want breakout confirmations. We want the breakout candle. We want the second candle to confirm the breakout. And then we want to enter on the third. Now, a lot of times after the breakout, the apex can turn into future support and resistance. The price sometimes returns to the apex or a support and resistance around the breakout before resuming the direction of the breakout. So a lot of times you'll get a break up or down, say upward. You'll get the second candle, but then it will come down back into that apex before it turns around and breaks back out. Okay. Don't panic when you have that. And then there are two methods for setting your price target. There's the two methods to estimate the extent move after the breakup. First, the widest distance of the triangle can be measured and applied to the breakout point. Second, a trend line can be drawn parallel to the pattern's trend line that slopes up or down in the direction of the break. The extension of this line will mark a potential breakout target. So to sum it up, triangle patterns are easy to spot and provide good risk reward opportunities. Traders can quickly know that a big move may be near, as well as a profit objective, and know about the possible risk. Now that you have the knowledge of the three powerful price patterns, you are steps closer to becoming a more confident trader. This is not very difficult. I trade from chart patterns, support and resistance, and volume. Okay. Because I believe price action is the ultimate indicator, and triangles are drawn right over price action. So what you're interpreting is what price is doing instead of some mathematical calculation that somebody's dropping on a chart. So keep this in mind. Now, if you also notice, there's two handouts on the screen, one called a guide to chart patterns and one called an introduction to technical analysis from investing.com. These are free for you. There's nothing you have to do. Just click on the little download buttons, and they're reference guides that you can keep and use at a later time. But they're only available during this live class. So please make sure you click on the download button and download them now. So try triangles. Try applying this simple basic strategy. Don't make it overcomplicated. Because remember, ultimately, all you're looking for is a high potential trade. You then have to use what's more important is your own risk management, because now that you know what the target point is and where you'd have to put your stop loss based on the triangle, you have to go back and calculate, can you afford to make this trade? Okay. Remember, volume is the confirmation, is the final confirmation, but you need the breakout candle, the confirmation candle, and trade on the third candle. When you try to skip those areas, you go back to that 52% right or wrong. Okay. We can't trade it at 52% right. And we don't want to get sucked into false breakouts. False breakouts happen all the time. By waiting for that third candle, you eliminate those false breakouts. And like I said, you might miss trading opportunities, but the ones you get will be successful. So thank you very much, and we'll talk to you again real soon. And if you go to www.alvexo.com, you can start out with their demo account and try out triangles. You can attend their academy and learn all about trading triangles. And thank you very much, and have a great trading night. Bye now.